If you are serious about reaching financial independence and retiring early or FIRE, you have to make a choice. It is a fork in the road for your investment strategy. On one path, you have value stocks. These are the supposed bargains, the overlooked companies that seem cheap compared to their assets or earnings. On the other path, you have growth stocks. Innovators, the market leaders, companies that are rapidly expanding their sales and profits. Many people will tell you that buying cheap is the safest way to invest. But for the specific goal of achieving FIRE, especially if you want to get there sooner rather than later, that advice is wrong. If you want to build $1 million plus portfolio in a decade or two, not 4 or 5, growth stocks are your most powerful engine. The entire FIRE movement is built on one simple, yet incredibly powerful idea: compounding. You need your money to make more money, and then you need that new money to start working for you, creating an unstoppable snowball of wealth. The faster that snowball rolls and the bigger it gets each year, the sooner you reach your goal. Growth stocks are designed for exactly this. They are companies focused on reinvesting every dollar they can back into their business to fuel more expansion, more innovation, more market share. This relentless focus on expansion is what can turn a $10,000 investment into $100,000 in a way that slow and steady value stocks rarely can. For FIRE, your timeline is compressed, and you need your investments to work as hard as you do. Value stocks, on the other hand, often present a false economy. They look cheap on paper, maybe with a low price-to-earnings ratio or a high dividend yield. But here's the catch: cheap can stay cheap for a very, very long time. Sometimes a company is cheap for a good reason. It might be in a dying industry, losing customers to more innovative competitors, or buried under a mountain of debt. Waiting for a turnaround that might never come is a luxury that someone pursuing FIRE cannot afford. Every year, your money is tied up in an underperforming asset, is another year you have to keep working. It's a direct delay to your financial freedom, and that is a price that is simply too high to pay for the illusion of a bargain. My own journey to financial independence was supercharged by focusing on growth. I invested in technology companies and innovators that were disrupting old industries. Were there ups and downs? Absolutely. Volatility is part of the game with growth stocks. But over the long run, the incredible upward trajectory of these companies far outweighed the temporary downturns. The gains I made from a few strong growth-oriented investments did more for my net worth than a dozen safe value picks ever could have. I learned firsthand that for the specific goal of accelerating your path to FIRE, you need to be where the growth is. It's not about finding what's cheap today. It's about finding what will be incredibly valuable tomorrow. The fundamental mathematics of FIRE favor speed. To understand why growth stocks are the superior vehicle for this journey, you only need to look at the power of compounding. Let's imagine you have $100,000 to invest. If you put it into a classic value stock portfolio that returns an average of 7% per year, which is a historically reasonable expectation, your money will double in about 10 years. That's not bad at all. But for someone trying to shave decades off their working life, it's just not fast enough. The FIRE journey is a race against time, and a 7% return is like driving the speed limit in a sports car. You're moving forward, but you are not using the full potential of the machine. You are driving. Now let's consider the growth stock alternative. These companies are often growing their revenues at 20%, 30%, or even more than 50% per year. While the stock price doesn't always move in perfect sync with revenue, the potential for higher returns is baked into their business model. If your growth-focused portfolio averages a 15% annual return, that same $100,000 doubles in less than 5 years. By year 10, you wouldn't have $200,000, you would have $400,000. That is the explosive power of higher rate compounding. This difference is not just a number on a screen. It's the difference between retiring at 45 versus retiring at 35. For every dollar you invest, you want the highest possible rate of return over your accumulation phase. And growth stocks historically offer that potential. Value stocks often pay dividends, which many investors see as a positive. They think of it as free money. However, for someone in the wealth accumulation phase of FIRE, dividends can be inefficient. First, those dividends are usually taxed every year, creating a small but consistent drag on your returns unless they are in a tax-sheltered account. More importantly, when a company pays out its profits as dividends, it's money that isn't being reinvested to grow the business faster. A growth company, by contrast, takes that same profit and uses it to hire more engineers, open new factories, or expand into new markets. This reinvestment is what fuels the rapid appreciation of the stock price, which is ultimately what you need to build a massive nest egg. Think of it this way. A value stock is like a farmer who harvests his crops and sells a portion every year. He gets a steady income, but the size of his farm doesn't really change. A growth stock is like a farmer who uses every bit of his harvest to buy more land and better equipment. For a few years, he might not have much cash in his pocket, but in a decade his farm is 10 times the size of his neighbor's. As a fire seeker, you are not trying to live off the farm yet. You are trying to acquire as much farmland as possible, as quickly as you can. Growth stocks are the strategy for acquiring that land. Think of your investment capital as your team of employees. You want to hire the most productive, energetic, and ambitious workers you can find. Growth stocks are your star employees who show up early, stay late, and are constantly finding new ways to generate revenue. One of the biggest siren songs for value investors is the idea of buying a great company after its stock has taken a huge hit. The logic seems simple. The stock was worth $100 a month ago, and now it's $50. It must be a bargain, right? This is an incredibly dangerous mindset known as catching a falling knife. The problem is that you, as an individual investor, almost never know the real reason why the stock is plummeting. A stock doesn't just fall because of a bad news headline. It falls because big institutions with teams of analysts are selling millions of shares. They might know something you don't, a fundamental problem not yet public. Buying a stock in free fall isn't contrarian. It's betting against the collective market, and most of the time, the market is right. A stock can drop because its flagship product is becoming obsolete, or because a major competitor is eating its lunch, or because the management team made a catastrophic error. By the time the stock looks cheap to you, the business may have deteriorated permanently. Guessing the exact bottom is speculation, not investing. It's a gamble, and gambling won't get you to fire. You need your money to grow, not act as a cushion for falling assets. While your money sits in a value trap, growth stocks keep marching up. Every decision you make with your money has an invisible price tag attached to it called opportunity cost. This is the cost of the opportunity you give up when you choose one option over another. For fire enthusiasts, understanding this concept is absolutely critical, and it is one of the strongest arguments against a value-heavy investment strategy. When you decide to invest your hard-earned money into a value stock that you believe is undervalued, you are not just making a bet that it will eventually recover. You are also simultaneously betting that it will outperform all the other investments you could have made with that same money, especially high-growth stocks. This is a very difficult bet to win. Let's break it down with a simple scenario. Suppose you have $20,000 to invest. You find a value stock, an old industrial company, trading at what seems like a low price. You invest your $20,000 believing it's a safe bet that will eventually go up. Over the next 2 years, the stock does nothing. It just bounces around the same price, essentially sitting flat. Meanwhile, a growth-focused technology ETF that you considered buying instead goes up by 40% over those same 2 years. By choosing the value stock, you didn't lose money on paper, but you suffered a massive opportunity cost. You missed out on an $8,000 gain. Beyond the numbers and opportunity costs, there is a significant human element to investing in value stocks: the emotional toll. A value trap is a stock that appears cheap but continues to stagnate or fall for years because of underlying business problems. Holding on to one of these is not just financially draining, it is mentally exhausting. Every day you check your portfolio hoping for a sign of life, only to be met with disappointment. This constant negative feedback can lead to a cycle of bad decisions, anxiety, and even cause you to give up on investing altogether. Imagine logging into your brokerage account week after week, month after month, and seeing one of your largest holdings colored in red. You watch as the overall market climbs, your friends talk about their gains in other stocks, but your bargain pick just keeps sinking. This experience creates a powerful psychological burden. You start to question your judgment. You might feel a sense of stubbornness, refusing to sell at a loss, because that would mean admitting you made a mistake. This is a cognitive bias known as loss aversion, where the pain of realizing a loss is so great that investors will often hold on to a losing position indefinitely, hoping it will one day break even. This hope is a terrible investment strategy. This emotional drain often leads to irrational behavior. An investor stuck in a value trap might engage in revenge trading, or they might double down on their losing position, a strategy called averaging down. They throw good money after bad, convincing themselves that if the stock was a bargain at 50, it must be an even better one at 30. This rarely ends well. Instead of cutting a small loss and moving on, they transform it into a catastrophic one. For someone on the path to FIRE, who needs to maintain discipline and a positive, forward-looking mindset, the stress and poor decision-making caused by value traps can derail the entire plan. In contrast, investing in a portfolio of strong growth companies, even with their volatility, provides a different psychological experience. While there will be downturns, the overall trend is often upward. You get positive reinforcement. You see your net worth growing over time, which fuels your motivation to save and invest more. It creates a virtuous cycle. I want to be clear that I am not immune to making mistakes, and I learned this lesson about value traps the hard way. Early in my investing career, I was still exploring different strategies. I had read all the books by famous value investors and was captivated by the idea of finding hidden gems. I identified a major health insurance company whose stock had fallen significantly after negative regulatory news and after a weaker than expected earnings report. From my perspective, it looked like a classic market overreaction. The company was a household name, it had millions of customers, and it was still highly profitable. On paper, its price-to-earnings ratio was the lowest in years. I thought I had found a sure thing. I made a substantial investment, convinced I was buying $1 for 50 cents. I felt smart, like I was seeing an opportunity everyone else missed. For the first few weeks, the stock bounced around and I felt confident a recovery was close. But the recovery never came. More bad news trickled out. Rising medical costs increased competition. The stock began a slow, grinding decline. I watched in frustration as the position went from a small loss to a significant one. My confidence turned into anxiety. I was stuck. My money was trapped and I was emotionally tied to the outcome. My mistake worsened. Instead of cutting losses and admitting I was wrong, pride got in the way. I doubled down. I bought another large chunk of shares at an even lower price, telling myself it was an even bigger bargain. That only increased my exposure to a failing investment. My portfolio, which had been growing nicely, began to stagnate because this one position acted like a giant anchor dragging everything down. Meanwhile, the technology stocks I owned were soaring. The opportunity cost was staggering. The gains I missed by having capital tied up were far greater than the actual loss I eventually took. After nearly 2 years of stress and zero returns, I finally sold the entire position for a painful loss. It was a humbling experience, and it taught me the most valuable lesson of my investing life. For FIRE, time, and momentum are everything. Waiting for a broken company to fix itself is a losing game. That experience solidified my focus on growth. It taught me to prioritize companies that are already winning, innovating, and leading their industries. That one bad value pick cost me not just money, but nearly 2 years on my FIRE journey. It's a mistake I will never make again, and one I hope you can avoid. Example: General Electric, a long-time blue chip. When its stock declined, many saw a golden opportunity. They bought in at $30, then more at $20, again at $15. Eventually it fell below $7. The business had deep systemic problems unseen from a simple PE glance. The evidence is clear. If your primary goal is to accumulate wealth as quickly as possible to achieve financial independence and retire early, your strategy should heavily favor growth stocks. It is not about being reckless, it is about being strategic. Your focus should be on harnessing the power of rapid compounding that only high-growth companies can provide. This means shifting your mindset away from searching for what is cheap and toward identifying what is innovative and dominant. Look for companies that are leaders in expanding markets, that are reinvesting their profits aggressively, that have a clear path to continued expansion. This is the fuel that will accelerate your journey to financial freedom. A practical plan for a FIRE seeker is straightforward. Dedicate the majority of your investment portfolio, perhaps 70 to 80%, to growth-oriented assets. This can be done simply and effectively through low-cost index funds and ETFs that track growth-heavy indexes like the NASDAQ 100 QQQ. You can also build a diversified portfolio of individual growth stocks in sectors like technology, biotechnology, consumer discretionary. The remaining portion of your portfolio can be held in cash for emergencies and opportunities, or in broader market funds for stability. The key is to ensure your capital is predominantly working in areas with the highest potential for appreciation. Do not let the allure of a fake bargain derail your entire plan. It is true that some of the world's most famous and wealthiest investors, like Warren Buffett, have built fortunes through value investing. However, it is crucial to understand that their strategy is not your strategy. They are managing billions, even hundreds of billions, of dollars. They can afford to buy an entire company or take a massive stake to influence its management and force a turnaround. They have the time, capital, and power to wait for a decade or more for a value play to work out. You, as an individual chasing fire, have none of those advantages. Your goal is not to reform a struggling company, it is to ride the wave of companies that are already succeeding. So, stop buying value stocks with the hope of a quick turnaround. Stop trying to catch falling knives, and stop letting your money sit idle in value traps while the rest of the market passes you by. Embrace the strategy that aligns with your goal of speed and wealth accumulation. Focus on growth. Invest in the future, not in the past. By doing so, you give yourself the best possible chance to build the wealth you need to retire early and live life on your own terms. The path to fire is paved with growth, and the sooner you get on it, the faster you will reach your destination. Postscript. This strategy is not foolproof, and no investment is guaranteed. Growth stocks are volatile and can experience sharp declines. The goal is not to be perfect, but to tilt the odds dramatically in your favor over the long term. Big investors will continue to buy value stocks, and sometimes they will be right, but their game is not your game. Do not model your strategy after someone whose resources and timeline are completely different from yours. For a faster path to fire, the choice is clear. Prioritize growth. If fire is your goal, stop playing defense. Value stocks won't get you there fast enough. Now that you know the truth, it's time to act differently. Subscribe, hit the bell, and let's build aggressive wealth with intelligent strategy. Your path to financial independence just got sharper. Don't waste it.